Hello, this is Bill Moreland with Bank Reg Data. Today I'm going to take a look at Truist Bank. I've been a little bit more vocal about Truist than maybe some others have. Their issues are not widespreadly known, but they are having some issues that are noteworthy to be discussing. So what we're going to take a look at here is in the upper left. I've got a little cheat sheet, as I always do. We're going to take a look at their securities, their core deposits, their funding, their loans, their delinquencies, their charge-offs, and their performing TDR, which is going to be a recurring theme in these reviews. First thing we see with Truist is that they essentially are showing quite a bit of growth, and then that growth has basically started to come back down. So the question that we have to ask ourselves, is that real growth, or is that the illusion of growth, or what is driving the drop in assets, right? They're a publicly traded entity, and we're essentially looking at $36-38 billion drop in assets, which I think banks are a little bit loath to do, right? Scrolling down a little bit more, we're going to essentially take a look at what our tear sheet shows us. And what we see right out here in orange, and if they're in orange, they're in the bottom 20% nationally, is that they basically have some securities portfolio issues. Their mark-to-market losses are 17% of book, and their securities appreciation depreciation is 47% of Tier 1 capital. So we'll dig into that a little bit more, but we are also seeing some other things that trigger what our list here is in the upper right. We're seeing quite a bit of restructured debt, and we're also seeing the same thing in Century. Their total loans restructured has climbed significantly from $860 million to $3.26 billion. Taking a look at their asset mix, we see that cash is sitting at 6.62%. Total securities is at 22.67%, and net loans leases are at 57.65% of assets. Their securities are about what other banks their size are doing. There's really nothing here that's alarming in that. However, we take a look at what the securities are, we see something that's fairly unique. And what I'm talking about here is this little box, this little section right down here. We see they're only sitting on $8.7 billion of treasuries, or about 7% of their mix versus peers at 20%. So typically larger banks hold more treasuries. But the one that's really shocking is that their mortgage-backed securities are sitting at $110 billion, or 92% of their security mix. Banks their size typically aren't holding that much mortgage-backed security. So if I click on the MBS, we can see that the numbers are coming down. But remember, part of that is a valuation. Part of that is maturing, but most of it is valuation. If we scroll down a little bit, we can see that they're holding a big chunk of Fannie, another $12 billion of Ginnie, and then about $40 billion of others. And their mix is extremely high. When we're looking at mortgage-backed securities sitting at 21% of total assets, 89% of the banks their size, the largest national banks, are holding less mortgage-backed securities. So where that creates a big problem for them is their appreciation depreciation. These are going to be the longest dated maturities, most likely, 20, 30-year maturities. And basically what you're looking at is a lot of losses. Right down here are their mark-to-market losses. We see that they peaked a couple of quarters ago at $27 billion. They're only worth 80 cents on the dollar. They've improved a little bit. They're currently sitting at little under 83 cents on the dollar. The number that's very shocking, and one that really, I'm surprised we're not seeing a lot more discussion about this, is that if we compared it to their Tier 1 capital, and if you look at their Tier 1 capital, 48.86 billion, 48.38 billion, 48.36, their capital is falling. But what we're looking at here is if they had to liquidate their securities portfolio, it's near 47% of their Tier 1 capital. And naturally, you're going to say, well, they don't need to do that, but it doesn't need a full liquidation to create a problem if they start to have a bank run. If they start to have a bank run, then that cycle starts to become uncontrollable for them. And once again, just to drive home the point a little bit more, their maturities. This on the surface doesn't look too bad. We're seeing a lot of blue. Blue is going to be 1 to 3 months, 4 to 12 months, and 1 to 3 years. So they do hold quite a bit short dated. The issue is they don't hold much except for mortgage-backed securities. They only hold $9.6 billion. So their non 1-to-4 portfolio is actually quite okay. The problem is $67 billion of this is longer dated paper, right? And so it's all red. 99% is 16 plus years. So this is not something that they're going to get out of easily, right? Time goes by and interest rates, even if they remain high, banks will heal themselves as their portfolios rotate into different into shorter maturities and higher yielding. The real problem that is noteworthy is their core deposits. And so this is when the Fed was just printing money, and we see that number climb and climb and climb up to $419 billion. And this is problematic for them. They have basically lost, what is that, $53 billion of core deposits in 2 years. And the observation here is they're betting that the Fed's going to fold. The Fed will fold, the Fed will fold, the Fed will fold. They don't want to pay higher interest on their core deposits. This is going to be the grandma option that you'll hear me often talk about. This is paying grandma, right? It's you, it's me, it's our businesses. And they're loath, big banks are loath to essentially pay higher deposits and set higher expectations. So what's happening is as they're losing core deposits, that's got to come from somewhere. And it basically comes from cash. And so we can see going back a year ago with Silicon Valley Bank, they jumped that number from 21 billion to 37 billion, and then it dropped, and then they've been slowly trying to build that number back up. And they did a pretty good job of getting, $4.5 billion of additional cash. And we'll come back to this a little bit later, but they're trying to rebuild that cash. But they've lost more core deposits than what they have sitting in cash. So that is the ratio you always have to look at. So how are they replacing these core deposits? We go to deposits, we go to broker. So this number has climbed substantially over the course of the last couple of years to where they're up to $31 billion, 30.6, 30.1, 31 billion of brokered. So this is paying grandma, but it's basically paying her through her Schwab or Fidelity account, institutional money, rather. So it's going to be shorter term. It's going to be, they're running campaigns, and what they're trying to do is not raise their core deposits, but they need to replace those deposits that are leaving. So brokered is one option. I don't see that they have any listing service deposits. The other options that they have are basically going to be FHLB, and we can see that they have replaced a good chunk of those, upwards of $25 billion, but that number's not grown. And other borrowed is going to be everything else. And that definition here is going to be right up here in the upper right. Promissory notes, notes and bills from Federal Reserve banks. The big one is the other. And I don't know, I've not looked at their quarterly filings with GAAP or their press releases. I would venture that they probably have taken some BFTP money going into the end of March, right? When there was that last ability to get some additional money. So what they've done is they're losing core deposits, and they really haven't stabilized that number. What you're hoping to see is that they get it, right? They get it, and they're gonna start finally growing it. And they had a $400 million growth. So perhaps towards the end of Q1, they decided that they were gonna start running more promotions in their branches and on their website to kind of keep that money coming in. Let's go to the other side of the balance sheet and start looking at loans. So lots of growth, right? A lot of growth. That's a lot of new loans coming on the books, and now they're not lending. If anything, their loan portfolios are shrinking. So on the surface, this is where people question my observation skills, which is perfectly fine. I would encourage it. And the reason for that is the delinquencies, right? So if we come in and we look at their delinquencies, they are going down, right? So what is the problem? Yeah, they have some mark-to-market losses. Yeah, they're having some funding liability issues with where they're getting and some cost structures associated with that. But we're not really seeing issues. So let's go ahead and we're going to go into NPLs, and we're just going to scroll down. We're going to look at the individual portfolios. So we can see their largest portfolio is C&I, and it's got a non-performing loan rate of 52 basis points. Nothing there alarming. The peers are going to be similar sized peers for each portfolio. So what we're going out and doing is we're getting the, $20 billion is their owner occupied. The peers are going to be the 99 closest to that 20 billion. On this 3.3 billion in credit cards, we're getting to the 99 closest on that $3.3 billion. So it's going to be apples to apples as much as we can make it. And we're not seeing a lot of red. This is probably one of the single best pages to look at in bank reg data to get a feel for whether or not a bank is having immediate issues. The only one that really catches our eye are auto loans. So we're going to go ahead and click on auto loans, which happens to be their fourth largest portfolio. Oh, excuse me. And we see fairly stable over the course of the last 4 or 5 months in terms of delinquencies. The percentage is climbing. Part of that's going to be they are shrinking the auto loans. Wait to buy a car. Do not buy a car right now, although it's better now if you're looking, but it's going to get better. So we see the big push of easy money, and they just kept lending and lending and lending, and now that's come quite down. So just this bank alone is down $6 billion net on balances. And the non-performing loans are higher. They are elevated. The 107, there is a seasonality component in it. The 107 is actually the largest they've been, right? That is a very high non-performing loan rate on auto. And if we scroll down, they're in the bottom, they're in the 94th percentile. There's a few banks that have higher non-performing loan rates, but this is one of the worst non-performing auto portfolios in the country. And we see that they're starting to take a lot of charge-offs as well. So remember, wait, because the more charge-offs the industry takes, the more repossessions, and the more supply that's going to be hitting the market. So I'm not suggesting to get a repossessed car, but obviously more supply will help even on other used cars as well as new cars as well. So let's go ahead and go back to non-performing loan. We don't see much else, right? So we're going to take a look at non-owner occupied because that is the other big portfolio. Consumer and CRE are the portfolios that are most problematic right now. And what we're seeing is the number has risen, but at 150, 170 basis points, we're not looking at a huge non-performing loan rate. We are seeing some accelerating charge-offs, right? They are starting to eat. So to their credit, they are charging these issues off. So once they go into late stage delinquency, they're not lingering. As we scroll down a little bit more to get an idea, that's the largest commercial real estate non-owner occupied charge-off rate they've had ever. Scrolling down, it's 97th percentile. So let's scroll back up and let's see what the consumers. So the two themes here for these guys are consumer, which is auto and other, basically elevated charge-offs, and their non-owner occupied is charge-offs. So on one hand, it is complimentary. It's admirable that they're essentially dealing with their issues. They're not keeping them. They're not trying to manage their earnings and keep those guys and come on, give me a promise. Promise you're going to promise. Promise you're going to kind of somewhat make a payment to delay those charge-offs. And yes, I'm a former collection manager, and that's how you manage charge-offs. Just get more promises. And then you can basically hold that loan or that delinquent to the next cycle or the next month to push past the current quarterly earnings. Not that we ever did that, but yes, it is clearly done. So the issue is TDRs. And you're going to hear me say this again and again and again. I'm going to go ahead and go back to total. Where banks are managing their non-performing loans is by restructuring them and not putting them on non-accrual. So typically when you restructure a loan, and restructuring or the new phrase loan modifications, softer, gentler, the guy can't make his payment, right? And if I owe $100,000 a month and I'm struggling and I reach out to Truist and say, I can't make that payment, I'm going to go delinquent, they will restructure it. And the point behind a loan modification or restructure is to get the payment down. Get it down to a level where Bill Moreland can make that $60,000 a month payment, even though I can't make the 100. And the rules, the guidance, always, historically, is you put them on non-accrual. The problem is, and non-accrual is you don't recognize any fee and interest income. So when Bill Moreland does make his $60,000 payment, and remember, the whole goal was to get the dollar amount to a level that the debtor can make it, the borrower could make that payment. So it's not like successful if they make the payment. That was the whole goal. The whole goal was to make it to its a payable dollar amount. So when I make that $60,000 payment, it all goes to principal pay down. The problem with this is banks are loath to do that during troubled times. So they will not put it on non-accrual. They will call it performing. And so the illusion here is that this bank has basically got no delinquencies, right? We looked at this. Most of their portfolios look actually very good. The few delinquencies are in consumer and CRE, and to their credit, they're charging those guys off pretty aggressively. They're not lingering. They are working through them and being done and trying to get them to post-charge-off resolution. But let's not forget sight that this bank has basically gone from $635 million of restructured debt to $2.4 billion. That's an incremental $2.4 billion that should be on non-accrual in a normal time frame, that they're not putting it on non-accrual. And so what you end up with is a delinquency rate that's considerably higher than what they're reporting. They're reporting a total delinquency of 3.66 or $3.7 billion. It's 1.19%. The problem is they got $2.4 billion that is not on non-accrual. And so it shows up as not delinquent. It's not an early, it's not a late, it's not non-accrual. It just doesn't show up. It's hidden. The reality is they have $6.1 billion of either delinquent loans or restructured loans. So instead of their delinquencies or troubled issues being a low 119, they're almost double at 197 basis points, 1.97%. So their issues aren't catastrophic, but they're worse than what people are being led to believe. And if we cycle through some of these guys, you can see on my cheat sheet on the left, we're going to go to construction, other land. That's huge. So they're reporting, you're looking at $104 million, and it was 54, it was 15, and it was 1. So this bank is basically reporting a delinquency rate of 38 basis points, when in reality, it's 5 times that number, 4 times that number at 1.64. So you can hide a lot of delinquencies when you don't put them on non-accrual. And they're doing that across the board. Look at that table. So we'll go into multifamily, and they're starting to do that. So we're only showing $2 million of stress or delinquencies in that portfolio, but there's another $80 million. So their real issues that they're worried about are 1.5%, not 4 basis points. Owner occupied, same story. Non-owner occupied, even larger. So they're upwards of 3.3% of their non-owner occupied is either delinquent or restructured, which actually isn't bad. There's some that are upwards of 10 big banks, but they're still worse than what they're reporting. And so here's a scenario where it looks like the C&I US is the C&I US is domestic C&I, commercial and industrial, that the number is skyrocketed. It's considerably higher, but it's gone down. But it's not gone down for good things. It's gone down because we restructured those notes 6 months ago or 9 months ago, and we didn't put them on non-accrual. So we restructured them 6-9 months ago. But now what's happening is they're going delinquent, and they're having to put them on non-accrual. So this shows you the damage. And we're now getting 12, 18 months on some of those first waves of restructuring. You're going to see the non-performing loan rate on a lot of these banks accelerate. Part of that is new delinquencies that are working their way into the system. But part of that is the delinquencies we ignored or avoided a year ago. And we're starting to put them on non-accrual, or we're putting them on TDR. We're modifying the loan. We're getting the payment down. The guy's supposed to be making the payment. He made the payment for 6 months, 9 months, and then he dips back into delinquency. And when he dips back into delinquency, you now have a restructured loan that is now delinquent in a short amount of time frame. You have to put them on non-accrual. So this is going to illustrate that you're going to see an accelerating non-performing loan rate at Truist well above where they're at right now. And the one that was really surprising to me is they're restructuring auto loans. So they're already showing a 3.26% delinquency rate, which we know is very high. We looked at it. It's like a 93rd, 95th percentile. But they also have another $859 million of restructured auto loans. So you're you're getting the payment down, right? It's a 7-year note, and they can't make it because the loan's $40,000, $50,000, $60,000. The only way you can make them make that payment to avoid a charge-off and a repossession is to add more time frame to it, which just adds more risk to that loan. These aren't insignificant discussions. So realistically, we're working at upwards of 7% of their auto portfolio is either delinquent or been restructured. And lo and behold, a good number of that is non-accrual. So we restructured them a year ago, we got their payment down, and now they're going delinquent again. So I'm going to be a broken record on this, but you have to look at TDR. You have to look to see if banks are artificially keeping their delinquencies lower because they're basically ignoring them. They're putting them on restructured, they're modifying the loan. But as I've just illustrated with their C&I portfolio and their auto portfolio, that second wave of delinquencies from the first avoided delinquencies from TDR is starting to take place. They're having to move these performing notes, restructured notes, into later non-accrual 6, 8, 9 twin months after they originally did it. So gloom and doom, no, but a different perspective perhaps, right? I mean, there's some issues here at Truist that we want to talk about. So I'm going to go ahead and I'm going to go back to earnings, okay? So we're going to take a look at earnings, and I'm going to look at pre-tax. And please understand, I'm looking at regulatory data. That's my focus. That's our business. You always have to basically look at their gap. But the reg is a big piece. And what reg is, it's the depository. It is the bank. It's essentially what's guaranteed within the FDIC structure for depository insurance. So this is going to be a large chunk, but the bigger the institution, the more likely they will have other complex businesses that sit outside of the depository. So you can have income coming from them that are not reflected here. You can have capital, perhaps, that's outside this, that's not reflected. So those are the ones you usually have to keep aware of. But the loans are all going to be there. The deposits are all going to be there. But if we look at just strictly the depository, we can see that they generated $1.4 billion of income. And it was lower. All right, so why the huge loss? A lot of banks took a huge loss in Q4, especially the biggest banks, because of the one-time large bank assessment that the FDIC did to replenish the FDIC insurance pool from what happened last year and the large banks going down, right? So they had to do that. So everybody had to pony up. And so I do, but I'm not trying to focus on it for here. That $5 billion loss, look, that's probably mostly driven by the assessment. But we are looking at $1.397 billion, which is their lowest, okay? These guys have a dividend yield on their stock at 5.5%. That is a very large yield. And what that means is the market's not real comfortable that they're going to maintain that stock price. And so that yield is being driven up. So what I want to talk about is, well, where did that $1.4 billion come from? And it comes from a lot of different places. But one of the places that it comes from is cash, all right? Now, in a 0% interest rate, you don't want to own cash. But we already talked about how they're increasing their cash numbers dramatically. They're sitting at $35 billion, up $4.5 billion quarter over quarter. But we now have the ability to look at Federal Reserve, due from Federal Reserve. So this is essentially the IOR. And so if I come over here and add this slick little, snipping tools and Excel are pretty much my de jour presentation skills. But they have $29.370 billion of cash. And it's paying out at 5.4%. That means they're generating $1.58 billion of annual interest. Now we know that they don't have that number there the whole time. The estimated quarterly income would be $396 million. But actually, I know exactly what that number is because it's right here under yield and it's under balances due. And there's that number that's real close to the $29 billion because there's some averaging that goes in where it's at during the quarter. That's the average of the quarter. And they generated $366 million. So you probably already jumped ahead. The $1.4 billion of income, 26% of it came from the Fed. So if you're looking at their dividend and you come back to income and expense and you go to dividend and we come down here and see that they paid out $1.2 billion of dividends and they only generated $1.22 billion, at least at their depository, that coverage is almost dollar for dollar. And it's one of the worst they've had, right? I mean, they always are running high, but this is not a prediction that the stock's going to go down. This is not a prediction that they're not going to make their dividend, but you're starting to see enough things here, at Truist, with their delinquencies, their TDR, and their core deposits issues. And, one last thing to talk about here is go back to this tear sheet. The orange is going to tell you where the issues are. Charge-offs, but I argue that that's not so bad. They're dealing with their issues. So low charge-offs is not always indicative of issues. They're dealing with them. So give them credit. They're working through those. They are doing a lot of restructured. They're paying a lot of money on that third-party funding, 5.5% on that. Their mark-to-market losses are very large. Their losses compared to capital are atrocious. But here's the last piece. Their insured deposits are only at 59%. And, a lot of big banks especially are going to be sitting at that number. But unless they dramatically start to reevaluate their marketing campaigns on short-term CDs and start to get more of that core deposit stabilization in there, this bank is still at risk. They've got a lot of mark-to-market losses. They're losing core deposits. They're starting to have delinquencies. And when people start to wake up that they're hiding delinquencies, all these things kind of work together to create a potential for a bank run. And I'm not predicting it, but if you put enough of these bad things together and you put enough of those banks that have these things together, that's the pool of banks where you're going to have somebody get in trouble. All right. As always, I appreciate your time. If you have any more questions or you want to debate this, I encourage you to basically reach out and give me a call. Thank you.